The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 149 of Wealth Talk. My name is Christian Rodwell, the Membership Director for WealthBuilders. I'm joined today by our founder, Mr. Kevin Whelan. Hi, Kevin.
Hello, Chris. Good to be with you again in these troubling times, I hear.
Yes, just you and me today, and we thought we'd spend a bit of time just to try and put people's minds at rest because, yes, lots of news around at the moment. We all know what's happening in the economy. Prices are rising almost every day, and it's starting to get worrying for people, and we understand that and appreciate that. So we're going to just look at a few different ways today that people can, perhaps think a little bit outside the box and, manage their money more effectively.
Things you can do when there's inflationary pressure around. As an old wizened economist like me, I've seen the odd bumps and booms when it comes to inflation. And I remember in the 1980s, Chris, late 80s, I had a mortgage which was 15.4%. Right? Now that's eye-wateringly scary, right? So I understand that when we've had a low inflation, quite stable economy for a decade and more, you suddenly get all of this uncertainty from the pandemic and the war, a whole range of other things, of course, leading to this inflationary pressure. And, that it is worrying, not least because there are some things that people simply cannot control. But let's talk about the things you can.
Okay. All right. So we've come up with 7 points today, and we like the
number 7. But if you keep me talking, Chris, I'll probably hit a dozen. But we can have a go.
Yeah. All right. So where should we start? What's the first point that people can take into consideration, Kevin?
Well, look, I mean, the inflationary pressure is coming from certain things. Okay. So let's be clear that we don't need to be knee jerk, and I certainly won't make a tongue-in-cheek observations I've seen from others. Which is, if you're really worried about fuel, for example, there's lots of property owners who have started to ride bikes around their area to see properties and find properties that are much more useful. So, there's little things you can do just to almost enhance your wealth building skills. But I'm not suggesting, we go to digging our gardens and making allotments to buy food. Everybody buys an electric vehicle, although I think there's some value in electric vehicle and hydrogen is catching up. And I'm definitely not suggesting kind of knee-jerk things like that. But one of the things I would say is you need to look at things differently. So in a new era where the current, I suppose the new order is disorder, you've got to get your brain in a place that deals with flexibility. And the best way to do that is to start thinking about spending some money in current pounds for education, because education gives you wider perspectives. Education, wherever you get it from, gives you more options, more perspectives, different ways that people can help you make a distinction. And those distinctions, as you know, Chris, are one of my favorite ROIs, the one relationship, opportunity, or idea from a complete transformation in your wealth. And what we're looking for now is to be sensitive to those ROIs. So investing in some education now, and it could be online, it could be free education, doesn't have to be paid for, but that you can use that education to take advantage. In an inflationary economy, you've got to be productive. You've got to produce something. And this is the essence in inflation, because things which are static will devalue. The money in the bank will devalue. Your money undeployed in your pension will devalue. The money in your property, just left there in equity will devalue. So the thing to do is to think about ways to be more productive. And that productivity starts here.
Yeah. And we've said many times before on previous podcasts, it's about thinking like an entrepreneur, becoming a value creator. And I guess there's two sides to this today, isn't there? There's reducing costs and being sensible in certain areas, but then also increasing your value.
Unquestionably, Chris. And, I think as an economist, it might be worth a little lesson. There are certain economic concepts that, although they sound complex, are really quite simple. And one of those, where there's inflation around, is something called elasticity of demand. So it sounds a bit bendy, it sounds a bit warpy, but it's actually quite simple, Chris. It kind of says this: if prices of something go up, does it abnormally affect the demand how does it affect it in a positive or negative way? Now, if you look at fuel prices rocket, but you can't do anything about that because the demand is inelastic. In other words, it doesn't matter what the price is, people still buy it. So one of the things you could be doing is thinking, well, okay, if I'm going to be investing my money, and I believe there's a long-term trend in inflation, look to invest in equities in those things that will be relatively inelastic. So certainly energy, you can imagine, you could just play your own mind about where there's strong elasticity or where the price goes up and nobody would buy it, compared to things when the price goes up, you still have to buy it. So we still have to buy fuel, we still have to buy in all different types. So you might be thinking about, well, let's look at alternatives. I'm not making a recommendation of what people should do here. I'm just saying it's to get the grey matter tested and start looking at, if you're investing money, you're already investing, unless your money is outperforming inflation. Now, equities generally will outperform inflation because there is production, and companies who are manufacturing things or making things or selling things or a service, if they've got relatively inelastic demand, that means the prices will go up so they make more profit. And if they make more profit, then they'll pay more dividends. And if they pay more dividends, likelihood is those dividends or that return will outperform inflation over the long term. That's what we generally see. But, you have to be, think about that. And especially now there's increasing pressure on finding alternatives, certainly to things like fuel. So I'd say investing in equities is an interesting one, and looking for those companies where there's inelasticity. So things that people buy and buy and buy and buy. Mm-hmm. And there are many companies and many products and many funds which focus on that. They won't be called inelastic demand funds, but you can use your grey matter now you understand what that means and start to think about doing that. And for example, one of the big themes when you're investing is understanding that wealth is produced by the creation of streams of recurring income. Well, why not look for companies that have recurring income? In other words, a high demand for their product that repeats and repeats and repeats. So you could think about nappies, shaving foam, things that people do every day. And there are funds, as I say, in organizations that specialize in that. So have a think about how you want to do that yourself.
Okay, so that was point number 2 then, looking for companies with strong elasticity of demand.
Or inelastic demand.
Okay.
So elastic would be the price goes up, the demand goes down, so you stretch. Inelastic is the other way around.
Okay.
But you get right. Anyway, it doesn't matter whether you get the terms right. You understand what I'm saying here.
Okay. All right. And then point number 3. So this is an area we've talked about before. I know you feel very passionately about this one, Kevin, and it comes up in our debits process. And we recently did an update to the S of debits, and that now stands for stock market fees. So point 3 is all about really observing what you're paying and reducing those.
Yeah, I mean, look, there are lots of things that get in the news where inflationary pressure is being shown and it's being reported and it's being discussed everywhere. but there are one or two that just get left off the radar. And if you think about what I just said about the increasing value of equities, and equities generally outperform inflation, then what does that mean in terms of the fees you're paying? Well, if you don't pay attention to the fees you're paying, your fees are just going to go up. So disproportionately then, more of your money that you could be earning from this increased growth as companies making profit because their prices are going up, then it means that more of that money is being retained by the institutions that provide access when you don't necessarily need all of that access. You don't need them to provide the access because there are so many layers of fees, which we call the TER, or total expense ratio. Again, boring terms and titles, but so critical when you're learning to build your wealth. You've got to reduce your TER. You've got to get the cost of investing down because you can control that. So you can get, most people are paying 2% for their money to be managed. 2%. That's huge. I mean, if you've got a big pot, that's massive. Whereas you can hugely reduce that. And in some cases, you could even get as low as 0.2. So 10 times cheaper, Chris. And when anybody's talking about prices going up and you can make something 10 times cheaper and you ignore it, then, that means your eyes off the ball. It means you're not playing the game of wealth building. You're being relatively lazy or allowing the wind that's blowing upon you to sort of upset you, and you just accept things as they are. That's not the case. You can change the direction of this. You can buffet yourself against these things by understanding what you can control. And we have a plan to help 100,000 people, Chris, reduce the cost of their stock market investing. And for the most part, if we do any work, we can pretty much guarantee to halve the cost. I think it will be rare. In fact, if we can't halve the cost, I won't charge for the work. For anybody who replies to this podcast, because I feel so strongly about it, if they drop us a note, you can tell people how they would get in touch with us, Chris, and say, look, I'd like to reduce my fees. If we can't reduce them by 50%, we'll do the work for free. All right?
Okay.
So passionate about, you can often get it 10 times cheaper. So I'm pretty confident we can reduce that by 50%. And if you can reduce something by 50%, that's good news. In an environment where there's so much bad news, why wouldn't you do that?
Yeah.
I'll tell you why. People generally get lazy.
Yeah. Well, definitely drop us a note, hello@wealthbuilders.co.uk, title Reducing Your Fees, and we'll get onto that one for you. Yeah. And we're talking, broker fees, platform fees, professional fees, all of those areas.
Yeah, there's just layers of them, and, we can bore people with the layers, but the easiest thing to do, we can do it, is just find out, because we've got an advisory team who can do that work, can find out what your TER is and say, these are the fees you are paying. Would you like to pay 50% or more or less?
Yeah. Okay. All right. So point number 3, they're reducing your stock market fees. So point number 4. So this one's about maximizing tax relief, I believe.
Well, if you think about, again, the bad news, if you can get some free money, right? If somebody gives you some money, that's good news. So tax relief means you're putting some money in, and usually when you put money in anything, you've had to pay the tax before you get it. Stated differently, if you're an employee and you save some money, then the money that you save, you pay tax on it before you save it. So while it's sensible always to minimize the tax you pay on anything, so definitely make use of tax shelters. So use your ISAs, use your national savings, use everything that's tax-free. Tax-free, though, just means the future growth is free of tax. But you can get tax relief, which means you get tax back. So you're getting the government to actually give you money. And that means you're getting a rebate, which means if that's 20% or 25% or 40%, whatever rate of tax you're paying in your company, it's around 19%. If it's personal, it's going to be the basic rate or the higher rate. If you can get the government to give you that tax back, why wouldn't you consider that? And you could do that. Usually the best way to do that, excuse me, Chris, is use your pension. So it's where so many people get excited about using the SSAS pension or a SIP pension if you're employed. Either way, use the tax relief where you get the tax back. And then if you imagine you're a company and you get 20%, give or take, tax back, and then you invest that in something you think will make you money, and you've chosen that well, then you're going to get at least that enhanced money invested as well. So that money's going to work for you. So it's like the government sharing in the risk with you, the government sharing in the value for you, but they're not taking any money out of the returns because they're also tax-free. So I would definitely say revisit what you have in your pensions and start to think about the three things then. Get some tax back, choose the right investment, pay the lowest amount of fees. Do those three things. Wow, you're really going to kick it when it comes to making better use of things.
Yeah,
so we're working in an environment, Chris. I can hear people around you arriving on a post-Easter blush.
That's it.
Charged and rejuvenated and ready to go after the chocolate, no doubt. Right?
The team are here, that's for sure. And that's a key point, isn't it? It's the redeployment here. Wherever those savings are made, it's redeploying it in a smart way. Yeah,
exactly right.
Yeah. Okay, so 4 points in now. Let's pause for a second and head to Trustpilot. And we haven't read out a review for a few weeks. So I've got one here from Richard who says, absolutely no doubt about it. I'm so glad that I'm now part of the Wealth Builders community. Every contact I've had with any member of the team has been a kind, professional and keen to help me sort of interaction. The podcast topics delivered by Christian and Kevin are very informative and really do help me learn so many new things about building wealth, and they educate me on how to protect my wealth too. The seeds are sown and I will be nurturing them to maturity. I am inspired and ready to learn so much more. So Christian and Kevin, keep on doing what you're doing and keep teaching us all.
That's almost a novella. That's a little essay, which is very elegantly strung together there. I think
thank you, Richard.
We need to talk to Richard because I'm so pleased we're helping him in a way that he's willing to share. So, yeah, great.
Yeah, no, really good. Appreciate that. Okay, so moving on now. Number 5. What do we hear then, Kevin?
Well, look, when people see prices going up, there's a temptation, isn't there, to panic. And one of the things you can do is you can consider two strategies here called hedging and banking. Now, what I mean by that is hedging means, if you're worried, then you could start, to increase that diversification. So hedging your money means, if you're worried about, let's say you take a different view and you're worried about your equities or you're worried about returns, we're talking here about invested returns, then what you can do is take stock again. So do a stock take, press reset, look at what you think the world's going to do. And if you want to diversify, you can hedge. And hedging takes a number of different formats. And it always demands more knowledge, Chris, because you can't hedge if you don't know what a hedge is. If you think it's just something for clipping, it's not really going to work for you. So hedging is about diversifying in a way that says, hey, I've got too much money in this area. I'm going to take some of that money out to reduce my risk and diversify. This is the key. So you want to reduce your risk and diversify. Now, hedging basically means you don't want things working in the same way. So just as we talk about wealth building is about multiple pillars, when we work with business owners, we talk about creating multiple streams of recurring revenue in their business and outside of their business, of course. But it's all about diversification. So most people, though, seem to have their wealth over-concentrated, well, obviously in the stock market. So the way to diversify for that is just to look at alternatives where you think there might be something different for you that you think could work. Now, again, Chris, I'm not recommending anything, but I can see there's been an increase in demand for gold. there's been definitely an increase in the appetite for learning around cryptocurrency and blockchain. We're seeing changes in the world that demand more of your education. So it means you could hedge in one or two directions that currently perhaps you're not looking at. So that's one of the ways to do that. The other way to hedge is to think about the fact that you may well, in inflationary times, be making gains. I mentioned that sometimes equities have a tendency in the long term to outperform inflation. So if you're making gains, then you can bank those gains. Now, again, that means different strategies, learning some things maybe you don't yet know. Chris, we did a podcast a while ago where, not gold, but I talked about the principle of GOLD, which is just an acronym, isn't it? Kev likes an acronym, which is identify your gains, take some of the gains off the table, which is the O, G for identify gains, O off the table, L, lock them in. So in other words, you made some money. Instead of going, well, I'm just going to, one day inflation's going to change, one day the market's going to change, I'm going to lock the gains that I've made in, and D is diversify. So I'll diversify that money into somewhere else that doesn't work the same way. And when something doesn't work the same way, Chris, there's another technical term for it, and it's correlation. So correlation means things work in the same way. Right? Counter correlation means they work oppositely or they work differently. So you would want to invest in things that work differently to what you're investing in. That way, you're diversifying and spreading and reducing your risk. Now, that's one way to hedge. The other way to hedge is learn some new strategies, and we've got some expertise within our Wealth Builders and our Wealth Builder coaching, which helps people understand how to create income in times like this from trading options. I'm not going to get into technicalities, Chris, here, but again, it's a new skill where essentially the easiest way to explain it is just to think about, if you've got a building, Chris, if you own a piece of real estate, piece of property, you're going to get a value from that as it rises over time, one hopes. And if that's the only method that you make that gain, you'd feel, hang on a minute, I'm underutilizing the value here. I'm just holding it empty. So naturally what people do is they create a rental income. So the rental income plus the capital gain is a double value, which is the reason why in inflationary times you want production, you want things to happen. The problem with owning gold, and if you listen to what Warren Buffett has to say, is if you own a kilo of gold, in 10 years' time, you still own a kilo of gold. It hasn't reproduced to create more. It's just you're banking on what you think the value would be. Well, that's not wealth building, that's hedging, right? So I'm not saying you can grow your wealth through holding commodities, because you can't, because you're not manufacturing anymore yourself. You're not creating anything. So it's about being a creator, not necessarily just a holder. But just going back to the options then, if you own the property, you get a rental from it. Well, if you own stocks, you can get rental from your stocks. In simple terms, you can let your holding to somebody else for a premium so that they and you can make decisions about where you think the market will go and create an income stream from that, from options. And, we have a process of teaching that. It isn't me who teaches that, but one of our coaches inside Wealth Builders. And we're very pleased about that as a growing area of interest now, Chris.
Okay, great. So thanks for explaining that. That was point number 5. Point number 6 then. So this again takes us back to that entrepreneur mindset, and especially, if you're employed, then looking at ways inside the business there, inside the company that you work for, that you can perhaps add some value and come up with some ideas that could generate an income stream for you.
Yeah, being a value creator means being a team player. We don't like wealth building on our own. We don't do DIY wealth. Go back to podcast number 1 or number 2, Chris, with the DIYers and the drifters. We're at Wealth Builders, we believe in the power of community and the power of teamwork. Now, if you're an employee, it's difficult to build wealth there. It really is tough. It's not impossible, but it's really, really tough because you don't own the asset. and therefore, the job can go as quickly as you got it. And you can't pass on the job to the next generation. So there's no long-term value in that. However, you can create a form of employment where if you're now being creative, if you're now looking in inflationary times where everybody's worried, including business owners, then you could look at that and say, well, can I find a way that would help my business make more profit? Can I find a way that will help my business save more cost? What can I do that sees life through the lens of the business owner, of the business in which, or the business owners in which I operate? And by using your brain and what you're learning, then you could potentially find a solution that says, hey, I think I found a way to make you money, save you money. Can I have a small share of that? Can I have it's inflation, so you're trying to make more money. So how could you create value where you're demonstrating that value, not just fulfilling a task? And that's this intrapreneur, being an entrepreneur in a business called an intrapreneur. And that's a fascinating way for people to...
Almost reminds me of Pillar 7, joint ventures, really. You're kind of joint venturing with your employer, aren't you?
You're joint venturing with your employer, and your employer is going to be open to anything if it's going to make them more money or save them money. So I would say I'd encourage that thought process.
Yeah. Okay, good one. So that takes on to our point, Kevin. Point number 7. I know we've not talked about mortgages specifically yet, but...
Well, it's more about debt, although mortgages are kind of more relevant because they're more understood about the power to use debt positively. Right now, inflation is rising, of course, massively, but interest rates are still low. They will catch up. So is there an option, if you think about if interest rates are low and you can lock in at a low rate, that will be your call. I'm just, again, posing an idea. If you lock in low interest rates, but then you can use that money to be more productive in terms of more property, for example, more real estate. I'm not suggesting people would invest in equities from debt. That's definitely not what I'm suggesting. But certainly debt equity for more property can be a good way because you're generating that increasing of the price of the property and an increase in the value of the rental, because rental would tend to go up inflationary as well. Then as part of the bills of people's lives for those who rent, then you can make money, but you've kept your costs down. But you've got to be very mindful of using debt leverage. It's great if you're producing an asset. So back to that idea about the production you're creating, you're turning that money into more value. But it's a double-edged sword. Debt is always a double-edged sword, and it can cut you. And it can cut you deep if you don't understand what you're doing. And we saw that in the crash of 2007-8, Chris, where many, many people over-leveraged. We got a property value crash. And again, like most of the things we're seeing these days, they come out of nowhere. They're not widely predicted by any economist, and certainly not me. And if you get in a situation where you've overgeared, which just means you've got more debt than you've got value, then many people went bust. And essentially all that property was, the debts were called in by the banks, and the banks just wanted to protect their position. So they weren't trying to seek out the maximum value for the property owner. They were just making sure they got their debt paid. So it's a double-edged sword, Chris, but if used well, then in the good use of low-cost debt in an inflationary economy can be a good way to get more power to the value of money that you have access to. It's not your money, you're borrowing money, but nonetheless, you're using that to good effect. So it's worth considering that, and it's definitely worth considering where you feel interest rates will go and reviewing with your mortgage broker. If you don't have one, let us know. We'll connect you to one who understands the power of regularly discussing where you are on your debt equity. And we encourage everybody that we talk to stress test anyway. So, you've got property, you owe X, what's that debt equity level? So if your property portfolio is worth $1 million and you owe 750, you're 75% debt equity. What's your objective? Do you want to get that down to 60, to 55, to 50, to 40, to reduce your risk over time? And you can do that over time, but it could be a very powerful injection to get you going to borrow debt when the cost is low in an inflationary environment.
Mm. Okay, and probably worth mentioning as well, your book, Save a Fortune Fast, Kevin. There'll be some very helpful advice in there, and we can link to that in today's show notes. A free copy for anyone who wants that.
Free. Yeah. So, that book was written in 2004, Chris. But the principles apply today. Just the examples of interest rates will be slightly different, just because when you write, you need to write in the current context. And I think the lessons are definitely worth picking out from there. I think there are 12 secrets to how to massively impact. As it says, save a fortune, how to completely eliminate your mortgage loans and credit cards fast. Now, that happened to be my strategy because I wanted to be certainly mortgage free as far as my own home was concerned. But I have used debt leverage, but I use it sparingly.
Okay, fantastic. Okay, so just a quick summary then of our 7 points today. So number 1, about getting education now, old pounds, to get value in the future. So
old dollars.
Yes, depending where you're listening from. 2 was all about that inelasticity. So looking for companies with strong inelasticity of demand.
Yeah.
Point 3 was reducing stock market fees. Point 4, we were talking about maximizing your tax relief there, was getting money back where you can. Point 5 was considering hedging. Then point 6 was talking to an employer, seeing if there are some opportunities to create some additional income streams and to benefit from that. And then our last point was really debt leverage at lower interest rates, if you can help to create, productive assets from that.
Yeah, and don't forget, you made a good point, Chris, about the point 6 there, one with the employer. You could equally look at other businesses because, in the latest book that I've written called The Wealth Coach, which is about creating recurring income in a business, you can become what we call a gateway, which means you don't actually own the business, but you can see a niche business area and you can become a kind of conduit to, people coming together, and then you could create something that was inflationary themed in the same way as, we use Martin Lewis as the example there, don't we? Where he doesn't have a business. I mean, he's not a bank, he's not an insurance company. He doesn't do any of these things. He basically brings the idea of the money saving expert. I help you save money. Well, you could become the inflation expert. You could create ideas that then pull together into some form of curated website or an article or a blog or something that says, the 10 different ways business owners can make more profit in inflation. You can just see life through a different lens. And the more that you exercise that muscle about seeing things differently, the more creative and the more wealthy ultimately you become.
Yeah. And if anyone listening has got some additional ideas, please, give us some feedback, send them through to us, and we can share those on future episodes with everyone.
Nice one.
Yeah, great. Well, thank you for listening today. And Kevin, we will catch up same time, same place next week.
Until then, my friend, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the WealthBuilders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.